On Friday, the U.S. Fed Chair Jerome Powell was seen as opening the door to rate cuts, perhaps next month. Our guest says Powell is getting it right in terms of his dovish tone on the economy. He has a stock that he thinks offers potential and one to avoid. We are joined by Brian Mulberry, Senior Client Portfolio Manager at Zacks Investment Management. Brian, thanks for joining us and kicking off the week.
Good morning.
What do you think? Will Powell cut next month? You're in the camp that says he will.
Yeah, based on his language from Friday's speech, he clearly acknowledged that there has been a change in the data. And if they're going to continue to be data dependent, then I think it is appropriate to adapt monetary policy. The two things we were looking for, I think he addressed very directly and at length. One was certainly the weakness in the labor market that happened right after the last FOMC meeting. Those large revisions indicate a weakness in the labor market that wasn't previously sensed in the data before. That big change alone could warrant a pivot in policy. But when you look also at the fact that he addressed that tariffs have not yet been really inflationary, nor do they expect them to be long lasting. In fact, the core drivers of inflation recently have been things not really driven by tariffs, things like shelter and airfare. Interestingly, maybe things that might be more influenced by higher interest rates that are causing higher prices in those specific categories. So that's why it was a big win for the market on Friday, as those cyclically interest rate sensitive sectors started to do very well based on the language and the expectation now, basically 100% chance of a rate cut in September.
Stocks, it looks like we're going to get it down, a slightly lower open this morning. Some of the euphoria fading.
Yeah, a bit of a breather there, no question. A really harsh run up on Friday based on those really strong expectations. No problem here, just a half a point give back as people kind of catch their breath and look at valuations.
What is your impression? Just give us your rearward-looking impression on the earnings season we've been through. It's still no big disruption from tariffs, it appears.
Right, and I think that's, again, furthering the commentary from Powell on Friday, is we've not seen a lot of corporations talk about tariffs impacting their bottom line. The biggest one being Walmart, obviously saying, yes, there's some impact on goods, but only about 10% of the goods, and most of those are the house brand generic type of names like Great Value or Equate, things that they really don't have a large margin to increase prices on consumers. So they're absorbing basically all of those costs. I think that's been happening more as we look at all of the earnings coming through. That's led to, I think, a better than feared Q2 earnings season, especially for the S&P 500. And when we get, basically back to a level feeling in terms of sentiment, we had all of these really bad fears coming out of early April that could influence the rest of the year and earnings and growth. It didn't happen. Those fears did not materialize into reality. We get this rally mainly because bad things didn't happen. So better than feared is the mood. It doesn't necessarily mean that we're on track for much better growth yet. I think we need that catalyst, which would be lower borrowing cost, a lower cost of capital, actually could drive better growth.
But you reckon that we do need real profit increases here, and just multiple expansions and optimism about AI, et cetera, won't be enough for a sustainable move higher in markets?
Well, what we want to see is more breadth in the growth. We definitely have 10 companies in the S&P 500 that are growing and growing very fast to the point where they now make up roughly half of the market cap of the entire S&P 500, and they account for 70 to 75% of the earnings growth. That's great, but it's not necessarily a strong sign for future markets in that any one of those missing earnings, those 10 companies, could have an outsized negative impact. You talk about NVIDIA reporting on Wednesday. They're 8% of the S&P alone. Whoa. If there was any type of disappointment, we could see a very large negative drawdown.
You have a stock idea for us, Amphenol. They make electric components and fiber optic gear. You see upside here?
We do. Given the task in monetizing AI, this is a great name doing exactly that. We know all of the capital that's being invested in trying to build out data centers, but also the power grid is going to have to grow as well. Amphenol is a company that's been around for a long time. They've been incredibly successful in the 5G growth globally, and they're just experts in electrical connections, mainly those tricky connections working with fiber optic cables. That makes them a prime winner when it comes to the dollars being invested in the infrastructure for AI to grow. They're going to be on site helping to connect the mainframes to the power grid using their expertise that they've built over the last 20 years in 5G.
One stock that you're wary of is a pharmaceutical name, Vertex. You say they're too dependent on one medical area?
Yeah, so they have 5 approved medications, but they're all to treat cystic fibrosis. And this makes it just a little bit too concentrated in our mind. They have one very specific target audience for the products that they're coming out with, and that just gives them a little bit too much risk dependent on that type of spending. The trend in CF spending over the last several years has been lower. While treatments are getting better and better, it's actually shrinking their audience, and so revenue growth is starting to stagnate around the fact that they're just overly dependent in one area of pharma, and competition is increasing at the same time.
Finally, Brian, before we let you go, is there anything, you mentioned the NVIDIA earnings, is there anything else you're looking out for in the week ahead as we near the end of summer?
We're looking for, again, just more breadth. We're a little bit cautious here at Zacks for the moment. We're a little bit concerned about too much concentration, especially just in the S&P 500. And we're a little bit worried that we want to see more earnings revisions to the upside from some of those S&P 490 names that we were just talking about.
Thank you very much indeed for joining us.
Thank you.
Kicking off the week for us there, Brian Mulberry, Senior Client Portfolio Manager at Zacks Investment Management.